We're good to go, people. We don't need no stinking gold. Sell that gold. We're good. Once gold gets to around 5,000 and the S&P's at 6,000, suddenly you're all the way up to 0.8, 0.9. And that's when you're getting closer and closer to the death cross. That's when gold passes the S&P. Whenever there's a crisis, gold goes down. No, gold is not a hedge against inflation. Gold is not a hedge against geopolitical risk. No, in the near term. Where gold is a hedge is when the whole thing burns to the ground. Okay. There's $250 trillion minimum in stocks and bonds. Gold outperformed and the miners outperformed because of uncertainty. Now the stock market hasn't crashed, so the Fed says that they have a dual mandate of stable prices and full employment. That's baloney. Those two mandates are out the window. When they sit down, now when they have a Fed meeting, that Fed meeting is only about one thing: stability, ensuring the stock market doesn't crash and the bond market doesn't crash. It's not ensuring price stability, ensuring full employment. It's manipulating the market so it doesn't crash. And so the uncertainty trade of gold hasn't arrived yet. And I've been saying the only chart that matters for gold and silver investors is the ratio of gold to S&P 500. Right now it's like 0.6, which is absolutely pathetic. So if you divide gold 4,250 into the S&P 500, 7,000, 7,300, it's around, I don't know, 0.6, somewhere in there. It's going to go over one. Gold, gold needs to outperform. So if you're going back and you look at the ratios back in 1970 to 2000, it was over one. Gold was outperforming the S&P. So that's what you're going to get when the uncertainty trade arrives. So we're waiting for the uncertainty trade. So geopolitical situations in the near term are beneficial for gold. They're absolutely beneficial, but not necessarily for the price in the near term, but the fundamentals improve. So that when the fear trade does kick in, it's like it kicks in on steroids. Then everybody's running to gold. And so I've been saying this, is that's the only chart that matters. So we need the S&P. First thing we need to get it below 7,000. So you get it below 7,000 and you're still going to be like 0.6. The ratio is still going to suck. But at a certain point, gold's going to get a bid. And so then once you get down to 6,200 on the S&P, 6,000 on the S&P, at that point, I believe gold will get a bid. So once gold gets to around 5,000 and the S&P's at 6,000, suddenly you're all the way up to 0.8, 0.9. And that's when you're getting closer and closer to the death cross.
Markets keep celebrating record highs, yet the ratio serious gold investors watch remains historically weak. Don Durrett notes that gold's real battle is not against inflation headlines, but against equity dominance. The overlooked figure here is a gold to S&P ratio near 0.6, far below levels seen during major uncertainty cycles. Wall Street focuses on price targets while ignoring relative performance, but wealth preservation begins when capital abandons confidence and seeks safety. For savers, that rotation matters far more than daily gold volatility. Next, Don Durrett reveals why a falling stock market may become gold's strongest catalyst.
And that's what I'm waiting for, the death cross. What is the death cross? That's when gold passes the S&P. So gold's at 5,500 and the S&P's at 5,400. That's the death cross. That's when we win. Until then, we just accumulate stocks. And then at that point, we got the wind at our back.
I asked you about geopolitical hedge, and you gave a great answer. What I want to add as a footnote is that I think you agree with me that looking at gold as a geopolitical hedge over 3 weeks or 4 weeks, but all these countervailing things happen, is the wrong way to look at it. And gold's not failing you keep saying it's performing well, but of course people are looking at the fact that it's down 1,000 points. It's performing well in your mind over the time frame that's relevant, which is more long-term than a few weeks, correct?
Right. So gold, Whenever there's a crisis, gold goes down. I mean,
Mhm.
it's somewhat bizarre. No, gold is not a hedge against inflation. Gold is not a hedge against geopolitical risk. No, in the near term,
Mhm.
it's not. Where gold is a hedge is when the whole thing burns to the ground.
Okay.
There's $250 trillion minimum in stocks and bonds. There's 70 trillion just in the US stock market alone. And there's more debt than there are, more bond debt than there is stock debt. It's about 100, 150, $250 trillion. That's where people put the majority of their money. Well, if that becomes at risk, right now it's not at risk, although the bonds haven't done very well for the last 12, 24 months. It's not really a place where people are running for something, for safety.
The biggest misunderstanding in finance is assuming gold should react instantly to every crisis headline. According to Don Durrett, the real hedge emerges when confidence in massive pools of financial assets begins breaking down. The critical number isn't gold's weekly move, but the roughly $250 trillion parked in stocks and bonds globally. Official narratives treat those assets as permanent stores of value, yet history shows confidence can evaporate much faster than wealth can relocate. For investors, that risk hides in plain sight. Next, Don Durrett exposes why short-term gold weakness often appears right before long-term capital flight begins.
So when those turn south and people run for safety, gold does well. Now, let's go back and look at the last two gold. This is an unusual gold bull market. Let's go back and look at the first two bull markets, the 1970s. 1972 to 1980, gold went from $35 to $850. When it was doing that, why was it doing that? It's because this 1970s was basically one crisis after another. It was the Jimmy Carter malaise. It was the inflation. It was the inflation decade. It was the energy crisis decade. But bottom line was this: gold outperformed the stock market because the stock market wasn't doing well and gold was an uncertainty trade. Then from 2002 to 2011, gold went from $250 to $1,935. And the stock market sucked. You had the dot-com bubble burst in January of 2000, and then you had then you had 1911 in September 2001, back-to-back basically hits on the stock market. You didn't have a new all-time high in the stock market until that decade ended. You had basically both of those decades, the stock market was terrible. Gold outperformed and the miners outperformed because of uncertainty. Well, now the stock market hasn't crashed. So the stock market did terrible in the 1970s and the 2000s. Guess what the stock market hasn't done lately? It hasn't been terrible. It's done nothing but go up. All-time highs after all-time highs, right? So unusual bull market in gold. Gold shouldn't be at these levels. Well, it's actually not. It's 24% below its all-time high. And I would submit the reason why it's down 24% is because the AI trade. People are like, I don't need no stinking gold. We got the AI trade. It's fine. It's the savior. AI is gonna grow us out of this problem. We're good to go, people. We don't need no stinking gold. Sell that gold. We're good.
This cycle is behaving nothing like the gold bull markets most investors remember. What Don Durrett is highlighting is a historical pattern where gold's biggest advances arrived during prolonged equity disappointment, not market euphoria. Gold surged from $35 to $850 in the 1970s, and from roughly $250 to $1,935 during the 2000s, while confidence in stocks deteriorated. Today's AI-fueled optimism may be delaying that transition, but it doesn't erase underlying debt risks. For savers, timing often matters more than narrative. Next, Don Durrett unravels why technology enthusiasm may be masking the same vulnerabilities that fueled previous gold booms.
The Fed says that they have a dual mandate of stable prices and full employment. That's baloney. Those two mandates are out the window. When they sit down, now when they have a Fed meeting, that Fed meeting is only about one thing.
Liquidity.
Liquidity is one thing, but that's not the underlying thing.
All right.
The underlying thing is stability.
Mm-hmm.
Stability, ensuring that the stock market doesn't crash and the bond market doesn't crash. It's not ensuring price stability, ensuring full employment. It's manipulating the market so it doesn't crash. Mm-hmm. That's the elephant in the room. When they sit down, it's like, okay, what are we going to do to make sure this thing the last Jenga peg doesn't come out, right? They've put transition. And the thing is, my point here is that they're not transparent. When they do these meetings, when the Fed comes in, and then the Fed speak and all these guys, they don't talk about stability. They can't. Scare the hell out of people. So they can't be transparent. They can't talk about what they're truly thinking, what they're truly trying to do. They're not trying to get inflation down to 2%. They can't. They're not trying to get 2%. They're trying to make sure that basically the whole thing doesn't burn to the ground. And we lose inflation, we lose inflation. And so it's all about stability, which is insanity. So stability is basically a recipe for disaster. Eventually the last Jenga peg's coming out. Mm-hmm. There's no way you can prevent it. It's a matter of when. I'm going to give one more anecdote. Is Jim Cramer, yesterday, he basically on his show, he gave about 4 reasons why he's bearish.
The Fed keeps talking about inflation, but its actions often suggest a different priority entirely. Don Durrett's argument suggests policymakers are increasingly focused on maintaining financial stability rather than strictly pursuing their stated mandates. Liquidity programs, emergency interventions, and market backstops reveal what institutions fear most: disorderly declines in stocks and bonds. Investors who only listen to official statements may miss the gap between public messaging and operational behavior. That disconnect becomes critical when portfolios depend on policy credibility. Next, Don Durrett reveals why preserving market confidence may have become more important than fighting inflation itself.
Right? But he didn't tell the truth.
Bearish on stocks?
Yeah, the stock market. Mm-hmm. And he gave about 4 reasons. But the real reason is stability. He's like, I don't trust this thing, right? This thing's ready to go, man. The real reason is that we've been living off of debt and that model's not working anymore. That's the real reason he's nervous. Not because Apple stock isn't, he's worried about Apple stock. That's baloney. That's not the reason he's bearish. That's my point, is there's no transparency, so you don't learn anything. You watch TV, they're not going to tell you the truth. They're not going to tell you what they're really thinking. the real reason why they're bearish. I'm going to tell you the real reason. You have to go on the podcast, and that's the only place you're going to really learn the truth.
All right, so let's back up a bit.
A debt-dependent system looks stable right up until the moment confidence disappears. This is where Don Durrett's thesis shifts from market analysis to structural risk. The deeper concern is not whether a single stock is overvalued, but whether decades of growth fueled by expanding debt can continue indefinitely. Financial media often debate symptoms while avoiding the foundation beneath them. For long-term investors, understanding that distinction may determine whether wealth is protected or exposed during the next major repricing event. The average American doesn't need to beat Wall Street to win what's coming next. The real mistake is believing that record stock prices automatically mean lower risk. Throughout history, the biggest wealth transfers happened when investors confused stability with safety. That's the warning hidden inside this entire discussion. If Don Durrett is right, the opportunity isn't waiting for a market crash. It's recognizing that confidence is becoming the most overvalued asset in the world. The people who protect their wealth won't be the ones reacting to headlines. They'll be the ones who noticed that while everyone was celebrating new highs, the foundations underneath those highs were getting weaker. And when capital finally begins leaving paper assets in search of certainty, that move won't happen gradually. It'll happen faster than most investors believe possible.